Hello, have a good day. Wonderful. Happy learning to you all. Today we will be focusing on profit creative incorporation, particularly problem solving point of view. So in the previous lecture we have learned why do we need to learn profit creative incorporation, what it means, what are the steps to be carried out, so what are the principles to be followed, and those things we discussed in the previous lecture. And now we are going to step in for solving your problems, 3 model problems in profit creative incorporation. So I have planned my lesson in 2 segments by solving 3 different problems. I hope you are taking a notebook and calculator, keep that everything along with you. Even though if you have mobile, but don't use mobile as your calculator. That's my kind advice. Okay? So use your calculator and notebook, and as soon as I summarize and solve the sum and travel along with me, so it help both of us to learn. Together. So the first sum which we are going to solve now is profit creative incorporation of Ganesh Limited. So Ganesh Limited is a company registered on 1st July 1997 to acquire the running business of Sunil Company with effect from 1st January 1997. The following was profit and loss account of the company as on 31st December 1997. And now they have given the list of income and expenses of the particular accounting period. That means January 1 to December 31. So they have gross profit in the credit side. In debit side, they have office expenses, formation expenses, which is expected to be written off, and then stationery and postage, selling expenses, director's fees, and at last net profit. This is the exact profit and loss account they have presented to us. Now we are required to prepare a statement showing profit earned by the company in the pre- and post-incorporation periods. The total sales for the year took place in the ratio of 1:2 before and after incorporation of the company, respectively. Now this is all about the brief explanation about the question. Now how to proceed. So we need to proceed the sum from the dates, whatever is given. The dates are most important because as per the principle we need to calculate 2 types of ratios. One is time ratio, the other one is sales ratio. Of course, the sales ratio is given in the question itself in this sum. Fortunately, they have given. Otherwise, they will give few details about the sales during this period, and then based on that, we need to calculate sales ratio. But fortunately, we got the sales ratio. The question itself is 1:2 in the last line. That time ratios that we need to calculate. So, take down all the dates. 1st July 1997 was the registration date, that means incorporation date. So before this date, before whatever the months or periods are there, those periods we call as pre-incorporation period. And after July 1st, that means from the date of registration, from the date of incorporation as Ganesh Limited, then after that we call that as a post-incorporation period. Now, what is time ratio? We all know time ratio means is the period between pre-incorporation period and post-incorporation period, which expressed in form of a ratio. So now take down the year and date, month as it is. So now the business is a running business, please be careful. The business is a running business. Business is not a newly started business in between the year. So since it is a running business, which means at the accounting year we can take the accounting period as 1st January 1997 to 31st December 1997. If it is a newly started business in this particular accounting period, then we can take that particular date of business starting till the date of registration, and then after the registration till the date of accounting period. We can consider that as for calculating time risk. But here it is a running business. Since it is a running business, we can take the date from the 1st of January as its account starts in this particular date. So now, for example, if this Sunil and company started their business on 1st March, say for an example, in the same year, and then in between 1st July it has been registered as Ganesh Limited, it has been incorporated. So in this case, we can take the pre-incorporation period from 1st March to the 1st July till the date of incorporation, that we can call as pre-incorporation period, and post-incorporation period as usual starting from 1st July, the registration date, till 31st December. But now the business is a running business, so we can take the first date of that accounting period until the date of accounting ending period, accounts ending period. So now the profit prior to incorporation or post-incorporation can be calculated based on time ratio. The time ratio have to be calculated from the date, from the first day of accounting year. Here it is mentioned as 1st January 1997 till 1st July 1997. That is called the pre-incorporation period. So if you count the months from January to 1st July, January, February, March, April, May and June. So we have 6 months because July company started. 1st July company started. So before that we have 6 months. So write that as 6 months and a pre-incorporation period. And then from July, in the same way, from 1st July, if you count the month till the end of this accounting period, it comes July, August, September, October, November and December. So totally 6 months. So post-incorporation period is also 6 months. So now pre-incorporation period becomes 6 months and post-incorporation period becomes 6 months. So 6:6. That's simple ratio, 6:6. If you are able to simplify this 6:6, because simplification is always better for easy calculation. Simplification is not must, but if we do simplification, it helps us a lot for easy calculation. So if 6:6, if we simplify this, it comes around 1:1. Because 1 6 are 6, right? 1 6 are 6. So you can easily eliminate the 6 and keep it as 1:1. So that is what is required. That is what is required for calculating this particular time ratio. Otherwise, what happens without simplification, it makes you to get delight by using calculator each and every time. Because if you take that 6:6, it becomes as 6:2, 6/12. So for all the calculation, you need to divide by 12 multiplied by 6. But instead of this, If you simplify this into 1:1, it would be easy for you to calculate, to segregate the expenses or incomes based on our need. So with this, let me take a note of time ratio and sales ratio. So time ratio is 1:1. Sales ratio is 1:2, which is given in the question itself. So these two are the important things for for segregating all the expenses before and after the incorporation based on the nature of expenses and income, whatever given in the financial statement, particularly income statement. If you now, I request you to go through the question properly and proceed for answering the question in your notebook as I detail the steps. Don't expect me to show you the answer immediately. I will detail the answer and please follow up along with the question, because you need to see the question. Right? I will explain you each income and expenses along with the reason behind that, and then use either time ratio or sales ratio appropriately and update your answer in your notebook. At the end, I will reveal you the answer in the screen so that you can verify your notes as well as you can make that in a proper format. I hope I am clear to you all. So let me proceed with the solution part, how to start. So first we need to start from the trading account, but here the trading account is not given, whereas they have given the result of the trading account as gross profit. They have given result of the trading account as gross profit, that is 2,25,000. So start from there. So let me request you have a table with at least 5 columns. With at least 5 columns. First column, let it be as details. Second column is the basis for apportionment. We call this term called apportionment, which means you are going to allocate the income and expenses based on time or sales towards the pre-incorporation and post-incorporation period. Hence, have the second column as the basis of apportionment. The third column is the total amount. Whichever is given in the question, we are going to write the amount with respect to that income and expenses. The fourth column have to be pre-incorporation period. Amount for pre-incorporation period. The fourth column to be amount for pre-incorporation period. The fifth column, it could be amount for post-incorporation period. So have this 5-column table. In a portrait form, you don't need to have a debit credit horizontal form. You don't need to have just portrait form. So because company acts advises us to prepare most of the statements in a portrait form, not like in traditional way, like ledger mode, debit credit, left side, right side, not like that. So now all the accounts given in the upcoming final accounts and all the accounts, whichever accounts, company accounts, company act advises us to prepare the accounts in a portrait form. under the name called notes of accounts. So for that, for all the accounts, we are going to use the similar columns. So let me repeat it again for your benefit. Details, basis, total, then amount for pre-incorporation, then last column, amount for post-incorporation. Now, start from the trading account. Since trading account is not here, let us take the result from the trading account, that is gross profit, which is given in this statement in the credit side of profit and loss account. Take that gross profit, which is 2,25,000. So let me request you to take the gross profit as the first item, and then basis of apportionment, let us decide based on our discussion, and then total amount, we can post the amount as 2,25,000 as it is given in the question. Now, what is the basis of apportionment? We need to decide that. So we have two bases. Actually, we have four bases. Remember that? Yes. One is time ratio, second sales ratio, third is purely for pre-incorporation period. That means no need to apportion, just allocate. And the fourth one, purely for post-incorporation period, which also we no need to have apportionment, rather we can allocate directly. So these are the four bases. So either one basis we need to follow under this, each income and expenses. So now, gross profit has the nature of sales, because gross profit is an outcome of trading account. Trading account is prepared purely based on direct income and direct expenses. Since the gross profit is here as an output of the comparison between direct income and direct expenses, that is sales and purchases and wages, all direct expenses. Hence, the gross profit, whichever is direct expenses, so it becomes variable nature. When it becomes a variable nature, then it has to be apportioned based on sales. I hope you remember the previous lecture which I delivered the last week, which you must have watched that. I gave a detailed explanation why a particular thing for sales ratio, why a particular account is for time ratio, and why a few items for pre-incorporation period alone, why few accounts only for post-incorporation period alone. Please go through that lecture. It helps you a lot to attend your multiple choice questions, which is asked in various platforms, particularly in your Swine platform also. So now, the gross profit is purely related to direct income, which means highly varying nature with respect to the sales. If sales increases, and with respect to that, the gross profit will also increase. Is it not? If the sales reduces, then with respect to that extent, the gross profit also will reduce. Hence, the gross profit is highly variable income, direct income. Since it is a direct, we can call this as varying nature. When it comes as under the term called varying nature, then we can call this have to be debit. This have to be used the sales ratio as the basis. Now, gross profit, use the sales ratio and apportion the amount into pre-incorporation period and post-incorporation period. So now that gross profit is rupees 2,25,000. Use the sales ratio. May I know the sales ratio from you? Yeah, post that in the comment. As soon as you watch this YouTube link, you need to comment. I will check the time of your posting and how many minutes you have watched. Are you traveling with me? So that also counts the internal amount. So now the sales ratio is given in the question. Yes, some of you started to comment. Very good. I could see 12 responses. Very good. The sales ratio is given in the question. I'm not asking a difficult question. So simple. Whichever is easy to answer, only that I will ask. So now the sales ratio is given as 1:2. So now apportion the gross profit of rupees 2,25,000 into 1:2 for pre-incorporation and post-incorporation. So 2,25,000, apportion that into pre-incorporation as 1 out of 3. That means 1:2 means 1 out of 3. 1:2 means the post-incorporation period is 2 out of 3. Because 1 plus 2, 3, no? So 1 out of 3 and 2 out of 3. So apportion those expenses. How did I say 3 means? This 1:3, the basic mathematics used to say 1:2 means 1 by 3, 2 by 3. Because 1 plus 2 is 3. So 1 by 3 and 2 by 3. So now apportion the rupees 2,25,000 to 1 by 3 for pre-incorporation period. So 2,25,000 multiplied by 1 by 3, you will get around rupees 75,000. I hope you are able to follow now. Rupees 75,000. Yes. Are you able to get? Yes. 1 by 3 of 2,25,000 is rupees 75,000, which you have to post in pre-incorporation period. And then after the post-incorporation period, the balance you can put up. Simply you can subtract from 2,25,000 rupees and minus rupees 75,000. If you subtract, you will get the balance. You can directly post in the post-incorporation period. However, you can use the same ratio to apportion the amount. So what is the ratio for post-incorporation period is 2 by 3. So out of 2,25,000, you multiply by 2 by 3, you will get rupees 1,50,000. So now you can also verify pre-incorporation period amount and post-incorporation period amount. If you add this, definitely you will get the amount, that is the total amount, whichever given in the question as part of gross profit. Please add these two and check so that you can ensure that there is no calculation mistake from your side. This always happens. Sometimes we may miss some zero, or sometimes we may miss some 1 or 2 number while writing. So it happens, this kind of clerical mistakes. It happens particularly for the commerce students, because some commerce students are so lethargic while writing the numbers. Because I used to see most of the professional people who completes the chartered accountancy and the CWA courses from the science background, then the commerce background. Commerce background students also clear, but with many attempts. But science background students, they study from the depth reason. So here, please use the logic of adding pre-incorporation amount as well as the post-incorporation amount and put up the total as the gross profit of rupees 2,25,000. You can verify that is the right or wrong. Right? So do that similar exercise for all the apportionments and allocations. So second, now this is the only revenue we have. Now let us go to the expenses. Now let me take you to the expenses one by one. So let us have a title called expenses. Other expenses, we can say other expenses because few expenses we also made before arriving to the gross profit. So these one can be called as indirect expenses or other expenses. Because when the profit and loss account is prepared, only based on the indirect expenses. Hence we can call this as indirect expenses heading. and then make the same columns with the same title, and we can proceed from each expenses one by one. So what are the columns? Let me repeat again for your benefit. Details, basis, total, amount for pre-incorporation, and last column, amount for post-incorporation. So now I request you to take one by one the expenses part from the profit and loss account debit side. So what are the expenses we have? The first expenses is office expenses. As soon as you take the expenses, first keep in mind the 4 bases. What are the bases are there in the apportionment and allocation? So keep that in mind and then decide which basis would be better to apportion or allocate this particular expenses. So what is the difference between apportionment and allocation? That is most important. Apportionment means you are dividing the amount into pre-incorporation and post-incorporation based on some ratio. Whereas allocation means you are directly posting that amount either into pre-incorporation or into post-incorporation based on its nature of expenses. So now, first expenses is office expenses. Basis, let us decide and put up the total amount, it is 54,000, which is given in the question. So now the basis of apportionment is that time ratio or sales ratio or allocation directly to pre-incorporation or allocation directly to post-incorporation. So this you can take as a multiple choice question and answer now also. So I was explaining in the previous lecture on what basis the time ratio is used. The time ratio is used for the expenses or income which carries based on the period, which has the nature of fixed charges or fixed expenses, which used to be made based on months or weeks, based on some period, based on time. So are we going to use those office expenses? Are we going to make those office expenses? Is that based on time or is that based on sales? Because allocation will not happen, because the office expenses used to be carried over a period of time. It's not only for pre-incorporation or only for post-incorporation. So let us take hence this reason arises. We need to say either time ratio or sales ratio. Allocation never happens, only apportionment is possible. So now the office expenses, which comes around rupees 54,000, it is purely a fixed expenses. So every month we will have fixed expenses. It has a fixed cost nature. Hence, this have to be apportioned based on time ratio. Office expenses, is that based on the sales what you make? Will it vary from period to period? No, it's not going to be. If it is so, then we can apply sales ratio. Here office expenses is not based on sales. It is highly fixed nature. It is not variable portion, it is purely fixed portion. And it is spent based on time. Whatever the office expenses you take in your real life, just think about, is that spent based on time or based on our turnover? Definitely it is based on time. The working people will definitely know that the office expenses is spent based on the time. So here, the office expenses 54,000. We need to apportion based on the time ratio 1:1. That means 1:1 means equally. So that's why we are simplifying the ratio 1:1. By seeing this itself, we can simply say it is equal proportion. So 1:1 means pre-incorporation period 1/2 and post-incorporation period is also 1/2, which means half and half. So now you apportion the 54,000 to pre-incorporation period half and post-incorporation period the another half. So 54,000 and divide that into 2 half. So if you say 2 half, or even if you calculate by using 1/2, multiply 1/2 with 54,000, you will get 27,000 for pre-incorporation period, and the same 27,000, not same 27,000, the balance 27,000. The balance 27,000 is for post-incorporation period. So that's how we need to apportion. So please make a note, it's not the same 27,000, it's the balance 27,000, which means the another 1/2. Since here the same ratio is there 1:1, but in the later upcoming problems, we may have different ratios like 2:3, 5:7 likewise. So that time you may get confused, you may write the same amount. No, it's not. It's right. The apportioned amount based on the time ratio with respect to pre-incorporation, and which is have to be apportioned for post-incorporation. If it is 1:1, we can say 1/2 for pre-incorporation, first 1/2, and the next 1/2 for post-incorporation. So hence, the 54,000 are apportioned to 27,000 and then another 27,000. I hope you are able to follow my explanation. This explanation is given for the purpose of attending the multiple choice question in a perfect way, which used to be posted every week in the Smile. Next, stationery and postages. This is another expenses given in the profit and loss account that amounts to rupees 5,000. Now, what is the stationery and postage? It is 5,000. How it is apportioned? Is that based on time, or is that based on sales, or is that to be allocated only to pre-incorporation, or is that to be allocated only to post-incorporation period? First, study the nature of that expenses. Stationery and postage, is that the regular expenses or variable expenses? If that is a regular expenses, is that fixed nature or varying nature? So if it is fixed nature, then use time ratio. If it is varying nature, then we may use sales ratio. If it is not a regular expenses, then we may think about to allocate either to pre-incorporation period or post-incorporation period based on the nature of that expenses. So now, the stationery and postage is purely has a nature of fixed expenses, because it's a part of official works. All the stationeries like pencil, paper, pen, pencil, all stationeries for taking printouts, and toner, all these things stationery. This has a fixed nature of expenses, because if you work in businesses or companies, they used to have a fixed budget for making the stationery and postage expenses. Since it has a fixed cost nature, we can allocate the expenses based on time ratio. So what is the time ratio now? The time ratio is 1:1. So now the amount is 5,000 can be apportioned to pre-incorporation and post-incorporation period by 1:1. That means 1/2 for pre-incorporation, then another part of 1/2 for post-incorporation. So good mathematics students will know 1/2 means half and half. So 5,000 if you allocate, if you apportion, then 2,500 for pre-incorporation period and another 2,500 for post-incorporation period. And next is formation expenses. This is another most important expenses which happens in the during the incorporation time. Formation expenses. First decide that is that formation expenses is that regular or irregular. Happens occasionally. So formation expenses is not going to be a regular expenses. It happens when you form your business, when you form a company. So you need to spend some amount for registration, or you need to spend some amount for purchasing stamp paper, you need to spend some amount for advocates or the consultants who helps us for registration. So this formation expenses is regular expenses. Hence it can be allocated but cannot be apportioned either by time or sales reason. So it is a pure allocation. Now let us decide, is that allocation happens pre-incorporation or happens towards post-incorporation? Yes, this happens. Formation expenses. When do you make a formation expenses? Only at the time of incorporation, only at the time of registration. The company is registered on 1st of July as given in the person, which means they have spent the amount on 1st of July, which means it happened during post-incorporation period. Hence, the formation expenses of rupees 10,000 can be allocated directly to post-incorporation period. I hope you are able to follow my words along with the reason. That is the most important. Not only the calculation, because commerce students are so good in calculation, but they will be so lethargic in keeping in memory the reason behind for each and every apportionment and allocation. That's why I am giving you detailed explanation on that. So now the formation expenses need to be allocated to the post-incorporation period alone. The full amount can be allocated to the post-incorporation period. So pre-incorporation period it becomes nil. No amount can be written that in the pre-incorporation period. So formation expenses and the basis put up as allocation. The total amount 10,000. The amount for pre-incorporation period is nil. The amount for post-incorporation period is rupees 10,000. So this is how we need to work on this. So I will repeat it again since you are following my lecture and writing in your notebook. Formation expenses in detail. And the basis is allocation, direct allocation. And then in total 10,000, just take from the question and write the amount with respect to formation expenses. And then the 10,000 can be allocated directly to post-incorporation. So pre-incorporation you can make a dash or you can write as nil. In post-incorporation you can post the total amount of rupees 10,000. So this is how we need to make the statement and allocate that particular expenses. The next is most important expenses, which happens to be in all the sums under profit related to incorporation models, that is director's fee. Let me ask you a question. When do the director comes into the picture in the business? Is that pre-incorporation period or is that post-incorporation period? That is one question you need to answer in the comment. Next, director fees. Is that going to be a regular move, which means from the date of starting of the business, or it's going to be occasional after incorporation? These two questions, keep that in mind and answer yourself. So here the director's fees happens to be only post-incorporation period. So here neither time ratio nor the sales ratio, because the director word, the name of director itself comes into the picture only after the registration of the company, after getting incorporation. So here the director comes into the picture only after the 1st of July. Only after 1st of July. That means the date of incorporation. Hence, the director fees need to be allocated, cannot be apportioned. This cannot be apportioned either based on time ratio or based on the sales ratio. It can only be allocated since it is a regular nature. It never happens before the incorporation. And now, since it has a nature of incurring the expenses only after the incorporation, only after the registration of the company, then this director fees of rupees 20,000 need to be allocated directly to post-incorporation period. Directly to post-incorporation period. So 20,000 allocated directly to post-incorporation period is rupees 20,000. I hope I am clear to you and you are able to follow all my statements and words and write in your notebook. Take the key notes with respect to multiple choice questions and answers. So let me summarize this particular thing. The director fees is a irregular nature which happens only after the incorporation, after the registration. Hence, there is no apportionment. We have only allocation. That allocation happens to be only to post-incorporation, not pre-incorporation. It happens only after the post-incorporation, after the registration. And hence the 20,000 can be written in the last column. So let me repeat it again. Director's fees under details and basis of allocation. Basis you can write as allocation. Total amount you can write as 20,000. Pre-incorporation amount you can write nil. Dash is 0. Whereas post-incorporation, the entire 20,000 can be written. So that's how we are following this summarized statement. Now the last expenses. We have only one expenses is left out in the question, that is selling expenses. That is selling expenses. So now we need to say, is that selling expenses, is that a regular expenses or irregular expenses? Will it happen only at the time of incorporation or only before the business? Register. So now what happens? Now we can design based on the nature of the expenses which we do. So this expenses is purely on regular basis. It happens on a regular mode. So in this, since it's a regular mode of expenses, we can use only apportionment, not allocation. only apportionment. So now what to do in the apportionment? Which ratio? Apportionment means what is the time ratio or sales ratio. Now it is a regular expenses, so let us bring into the apportionment. Now the selling expenses, the word itself says as it is selling. Sales. So it is directly related. So since it is a varying expense, where the selling expenses varies based on sales. If the sales increases, the selling expenses will also increase. If the sales is so less, then selling expenses become so less. So it is directly varying expenses with respect to sales. Hence, the selling expenses have to be apportioned based on sales to receive. That is 1:2. Now only we are using that 1:2. Is it not? So which is given in the question directly, the sales ratio. We need to use that 1:2 for apportionment of selling expenses. So now the total amount of selling expenses which is given in the question is 60,000. So now we need to apportion that 60,000 into 1:2, that is 1/3 to pre-incorporation period and 2/3 into post-incorporation period. So 1/3 means out of 60,000, 1/3 comes around to the sum of rupees 20,000. So 60,000 multiplied with 1/3 will get 20,000, which have to be apportioned to the pre-incorporation period. And the balance out of 60, subtract the 20,000, the balance can be written as post-incorporation period. Or otherwise, you can take the sales ratio for post-incorporation period as 2/3. So now we can very well apportion the sales ratio 2/3. After rupees 60,000, you will get rupees 40,000 under post-incorporation period. Is 40,000. So now you can also check 20,000 and 40,000 together, 60,000. Some people directly take the balance, and you may also use the ratio, but you will get the same answer. So this is how we need to solve this. And before deciding the ratio, before deciding the allocation of apportionment, before deciding the ratios, we need to know the reason behind everything, because this is what is expected in multiple choice questions which used to be posted every week for calculating your internal mark in SWOT platform. Please make a note the reason behind for each and every allocation and apportionment. Then only you can easily and effectively answer the multiple choice question without any trouble. So now, which one is left? Can you say which one is left from the question? Yes, one thing has been left. Post that in the comment. So post the account which we have left from this question. Yes, we left is the net profit. Two of you only commented. Very good, you identified the comment. I could see two names. So two people are following that. Hey, the entire class. Yeah, now it's coming. So net profit we have left. So net profit is an excess of income over the expenses, which means excess of gross profit over to the indirect expenses together. So if you see the excess amount, then it is called as net profit. So now what we need to do is that we need to calculate the profit already it is given, but we need to calculate by subtracting the gross profit and so by subtracting all the expenses from the gross profit. That comes and that amount need to be verified for pre-incorporation period balance amount as well as the post-incorporation profit amount. So now I will review you the answer part for the benefit of your verification in your notebook. So now let me take you the solution part table. So it is a notes of accounts. It has 5 columns, as I said to you. The details, basis of apportionment, total, pre-incorporation period, and post-incorporation period. Take the gross profit, sales ratio, as I said, it has been apportioned. The total amount has been divided into 75,000 and 1,50,000. This is how you have done. Next, I asked you to take all the indirect expenses. Now, office expenses, time ratio 1:1, 54,000 per annum. And if you portion this, it comes around 27,000 and 27,000. Stationery and postage, it is again based on time ratio. So 1:1, the 5,000 is allocated to pre-incorporation period 2,500 and post-incorporation period 2,500. Next, formation expenses. So here it is a irregular expenses. So it has to be allocated, not apportionment. It has to be allocated based on the period in which this has been incurred. So formation expenses is normally incurred during the post-incorporation period. So because the time the company is formed, the company is registered. So you can directly post that amount 10,000 into the post-incorporation period, and hence the pre-incorporation period becomes 0. Then director's fees. This is also as an irregular expenses to the entire business for this accounting people. You may give director's fees every month or every visits, but it happens only after the incorporation. The director name, the board of directors comes to the picture only after the incorporation, after the registration of company. And hence, director fees is not a regular expenses which happens during the entire course of business. So it is irregular, so it has to be allocated. It has to be allocated either to pre-incorporation or post-incorporation based on its nature. Based on its nature of the expenses which we incur during a particular period. Since the directors comes into the picture only after the registration, the director's fees of rupees 20,000 directly allocated to the post-incorporation period, rupees 20,000. Next, selling expenses. Since the word itself says it is sales, related to sales. So we can also say, sorry for the interruption, let me continue again. The selling expenses. It is a regular expenses from the day one of the business. Because from the day one we start to sell products in the market. So selling expenses is a regular expenses. So this has to come in a portion. Now let us decide is the time ratio or sales ratio. The selling expenses is totally related to sales. The word itself says. Is the word itself says as the sales, as the selling expenses. Hence, it can be directly allocated into 1:2. So 60,000, if you divide that based on 1:2, that means 1/3 and 2/3. 1/3 for pre-incorporation period, that is 20,000, and 2/3 for post-incorporation period, that is 40,000. Now sum up the entire income and expenses. So we have only one income, that is gross profit, that comes 2,25,000 is the total. Pre-incorporation period 75,000. Post-incorporation period 1,50,000. Whereas in the other expenses, if you see office expenses, pre-incorporation period 27,000, post-incorporation period 27,000, stationery and postage 2,500 and 2,500, formation expenses directly to postal corporation 10,000, so pre-incorporation nil and post-incorporation 10,000, director's fees pre-incorporation nil and post-incorporation 20,000. Selling expenses 60,000. Now pre-incorporation is 40,000 and post-incorporation is 40,000. Now we need to sum up all these expenses. So total column 54,000, 5,000, 10,000, 20,000 and 60,000. If you sum up this, use calculator and sum up. If you sum up this, it comes up that is 1,49,000. Now if we need to sum up the amount percent for pre-incorporation, and that is office expenses 27,000, stationery and postage 2,500, formation expenses nil, director's fees nil, and selling expenses 20,000. To sum up this, you get rupees 49,500 under pre-incorporation period. Then, if you sum up this, you will get 49,500 under pre-incorporation period. These are expenses. Now, post-incorporation period. So, what is that expenses? Post-incorporation period, we have office expenses rupees 27,000, stationery and postage rupees 2,500, formation expenses rupees 10,000, director's fees rupees 20,000, selling expenses rupees 40,000. Now, if you sum up this, it comes around rupees 99,500. Now, put out this total in the form of a final solution to calculate the profit pre-incorporation and profit post-incorporation. Am I clear? So take only the total gross profit and take total expenses and make as a table. So that table which I am going to reveal you now, so that you can be as it is. So rather than this you can have particulars note number total the pre-incorporation period and post-incorporation period. So here what you need to do is that have a title first, because the title is most important. Statement of profit and loss of Ganesh Limited for the year ended 31st December 1997. So have a 5-column table in a portrait form, particulars, note number, total amount, then amount for pre-incorporation and amount for post-incorporation. Now the particulars, you may have revenue from operation. So what is the revenue from operation? That means we have only one revenue, that is gross profit, which already summed up to the sum of rupees 225,000. This has been taken from note number 1. And if you take the total of, now we are not going to apportion, we are not going to allocate, we are neither going to apportion nor going to allocate. Whatever we got the total, we are going to write here. So 75,000 and 1,50,000, we can write as this. And subtract the expenses. So take the expenses together, the sum, the total which we have done in the previous screen. So what is that? Yes, total 1,49,000 total expenses. The total of pre-incorporation expenses 49,500 and total of post-incorporation expenses rupees 99,500. Now, profit for the period, it comes around, which we have to subtract 2,25,000 and 1,49,000 to subtract, you will get 76,000 as profit. So, which is the net profit in the question data. The question itself is their net profit. The same amount have to come. Net profit is 76,000. Then subtract the sum pre-incorporation column, revenue, and subtract the expenses. That is 75,000 minus 49,500. So if you subtract, you will get 25,500. And same thing we can follow for post-incorporation period. 1,50,000 is the revenue from operation, and then subtract the expenses, that is 99,500, which comes around 50,500. So now profit prior to incorporation is 25,500 and profit after incorporation, which means post-incorporation, is 50,500. Now we need to understand what do we call that 25,500 and what do we need to call 50,500. The 25,500 is called as capital reserve, and the 50,500 can be denoted as revenue profit, which can be used for the distribution of dividend of the company for this particular year. Even the net profit comes around 76,000. The entire 76,000 cannot be utilized for the distribution of dividend, because the entire 76,000 is not the revenue profit which earned by the company after its registries. The entire 76,000 is the amount before incorporation as well as the post incorporation. That's why we are working out these statements. So now we identify the profit earned before incorporation, that is profit prior to incorporation, to the sum of rupees 25,500. With this we call as capital profit, which have to be transferred to capital reserve account and shown in the liability side of the balance sheet. Whereas the post-incorporation period, the profit we gained during the post-incorporation period, that is rupees 50,500. So this is called as revenue profit, which can be shown as profit and loss account and a balance sheet liability side of the company. As profit and loss account is a revenue profit. Now there used to be a question: if it is a negative amount, what to do, sir? For example, if the revenue from operation for pre-incorporation period, instead of 75,000, it happens to be only 30,000. Expenses is as it is for pre-incorporation period for rupees 49,500. Revenue from operation was 30,000, whereas the expenses happens to be 49,500. Now there is no profit. If you get, now you get a negative amount, minus 19,500. So what happens? This can be called as loss for prior to the incorporation, which means this can be referred as goodwill, which have to be shown on the asset side of the balance sheet. If it is a loss in post-incorporation period also, then that loss also have to be shown under the asset side of the balance sheet as profit and loss account. If you see any profit and loss account in asset side, which means the company has accumulated loss over a period of time. So this is how we need to learn So let me come out with few multiple choice questions from my lecture which I deliver now. So please show your keenness in listening the questions and simultaneously answer your correct option in the comment box in this YouTube video. So I'll be watching. Are you able to post the comment at the appropriate time? Continuously watching this lecture, so which will be used for evaluation. So now let me post few questions, multiple choice questions. From this exercise only, from this video lecture only, not I am going to use any other thing. So only from the profit creator incorporation with respect to today's class. Question number 1. How do we show the loss prior to incorporation in the balance sheet of the registered company? Let me repeat the question. How do we show the loss prior to the incorporation in the balance sheet of the registered company? Option 1, not possible to show. Option 2, it can be shown as liability, as profit and loss account under liability. Option 3, it can be treated as capital loss and shown under liability. Option 4, it can be treated as goodwill and shown under asset side of the balance sheet. So now I request you to post the right option with the answer in the comment. So I repeat again the option 1. So profit and loss account in liability side. Option 2, capital loss in the liability side. Option 3. Option 3. Yes. The profit and loss account in the asset side. Option 4, goodwill account in the asset side. What is the right answer? I will tell you the right answer later on. Question number 2. The profit prior to incorporation is referred as dash. Option 1, capital profit. Option 2, capital loss. Option 3, revenue profit. Option 4, revenue loss. So which is your answer? Yes, are you able to follow my words? The profit prior to incorporation is referred as dash. Capital profit, capital loss, revenue profit, revenue loss. Let me challenge you to post your answer in the comment. Now, question number 3. Question number 3. So what is that question number 3? Question number 3 is that the profit post incorporation, please make a note, profit post incorporation is treated as dash. Option 1, capital profit. Option 2, capital loss. Option 3, the revenue profit. Option 4, the revenue loss. What is your answer? What is your answer? Yes. Similar option I have given for question number 2 and question number 3. But answers may differ. Now question number 4. Are you able to post your answer? Yes. Few of you posted, I could see. The next question is the capital loss is referred as dash. capital loss is referred as DAS. Capital loss referred as DAS. Option 1, accumulated loss. Option 2, capital reserve. Option 3, goodwill. Option 4, retained earnings. I'll repeat again. You want me to repeat? And options. The capital loss is treated as DAS, is referred to be as DAS, capital loss. Profit and loss account, and then capital reserve, and then goodwill. The fourth option is revenue loss. No come up with visualization. So with this, now let me complete this particular session, and I request you to proceed further learning. Keep on learning. Learning is our life. Once the learning stops, we die. And have a happy learning. Don't have a trouble in learning. So try to have a happy learning in each and every atmosphere. Thank you. Have a wonderful weekend and continue your thoughtful learnings. Thank you. And the answer for these multiple choice questions is that question number 1, the answer is goodwill. Question number 2, the answer is capital profit. Question number 3, the answer is revenue profit. And the question number 4, the answer is goodwill. I'll repeat it again. Question number 1, goodwill. Question number 2, capital profit. Question number 3, revenue profit. Question number 4, goodwill. So with this thought-provoking session, let me pause for some time, for a week time, and let us continue the same chapter in the upcoming class video. Thank you. Have a wonderful weekend.